Welcome back to Market Minutes, everybody. Today I'm joined by Harley Gold, President and CEO of Peakhill Capital. Today we're going to talk a little about the U.S. credit market. Thanks for being here, Harley. Peakhill has been active on both sides of the border. Obviously, started here in Toronto, recently started doing business in the United States, both on the credit and the equity side. What are we seeing? What's driving the market there? And that's really topical.
So we like credit a lot. In the past year and a half, we've become very active. We didn't like it as much over the last 5 to 10 years as I like it right now. And even throughout my career, I've been doing lending in the US, 27 years ago when I started doing my first loans. Was a really active time as the markets were growing. Credit over the last 5 to 10 years in the US has been a super competitive space with the regional banks, very competitive, looking to grow their portfolios. There's been a lot more consolidation of banks, so you don't have as many regional players. You have more larger banks today, given after the financial crisis, regulatory requirements and things like that. And so I think there's been a loss of the regional focus for borrowers and developers. And I think we're really good at trying to find those markets where we can become experts and we can actually help the local borrowers and understand the market maybe better than a national player. We've seen regional banks cut back, given that they had construction loans that they had to deal with. Projects may have taken longer than they would have thought. Costs were escalating in an inflationary environment. The borrowers were dealing with some challenges with respect to that. And the takeout loans on those projects had some challenges. Lease up also was a challenging period of time. Rents were quite elevated for many years, and the growth was really strong. And then you reached a period of time where there was a lot of building, a little bit of oversupply in certain markets, and so you had vacancy go up, you had rents fall, and so going to be a lender in that market environment isn't the best time to be a lender. Now things have sort of settled down a little bit. Where it's a good entry point to be a lender. And so our plan is to grow within specific markets that we have a team, understand those markets and really understand our borrowers and have good opportunities to lend at good credit from a safe perspective, a credit underwriting perspective, and also a return perspective. The less competition there is, sometimes it can be better, or you're providing a real need in the marketplace. And so we're trying to focus on products that we see a good need for the borrowers in the markets that we're operating. And I think there's a good need today that may have not been as good as last 5 or 10 years.
You mentioned some of the micro trends that we're seeing, and I want to get back to that in a second, but you also mentioned the products that we're using. Specifically, I'd like to talk about the CMBS market. We're seeing increased levels, highest since 2007, pre-Great Financial Crisis. Talk me through that. What does that mean from a lender's perspective and a borrower's perspective, and seeing those increased levels?
Yeah, so typically CMBS, has been a place where you can get more loan proceeds, right, than a typical life company or a bank in terms of your loan amount, higher loan to value, 70, 75% typically, whereas a bank you might be 60, 65%, or life company even lower today based on debt service coverages. And so CMBS provides that opportunity to provide some more financing. The pricing is a little bit more, but you can do some interest-only structures, 5 years, 10 years interest-only, where typically banks are looking for 25, 30-year amortizations, as well as life companies are looking for shorter amortizations as well. So there is a place for it. Investors are interested to invest in the space a lot more. CMBS has improved in the performance of returns of trading and owning CMBS, and asset classes have recovered. Retail's done really well, industrial, hospitality's done well, and multifamily obviously has done well in that space. Office had some challenges, been some recoveries, but those weren't all the CMBS type of loans. That was a part of it. But CMBS has made a comeback. There's more investor interest. We're active in the space. There's more borrowers looking at that solution. It might not have been their first solution in the past 5 to 10 years, but now we're seeing it come as a real viable solution that other lenders may not be able to satisfy. So I would say it's a combination of the investor appetite to buy the securities. So a lot more investors today interested. Spreads have come down a bit. And then you have borrowers that are looking for other capital sources. As I mentioned, the banks, they've cut back a little bit in some regional areas. And CMBS can be a good place to do 5 and 10 year financing at higher leverage points than the life companies. The life companies are more interested in lower leverage, higher debt service coverage, maybe 1.5 times, 2 times debt service coverage. Whereas CMBS, you can push the coverage a little bit more, 110, 120, 130 debt service coverage, so you can get a better, a higher loan, typically.
Are there barriers to entry, or?
I mean, historically, a long time ago, there were a lot more CMBS lenders, but today you have to have more capital requirements. You have to be more invested in the space and retain part of that investment in the securities. Previously, that wasn't a requirement, so there's been some changes. That's a requirement there. So it's the retention that's required, as well as you have to have the ability to service the loans, monitor, report, and so forth. And so we have a big team that's capable of doing that. We are a rated servicer by Fitch as well. So having that capabilities as we grow, we're continuing to build that out.
Before we mentioned some of the more microeconomic trends that were impacting the market that we decided to enter, but on a macroeconomic level, we're seeing almost somewhat of a different story. We're seeing a lot of geopolitical risks. We're entering the midterm election. There's uncertainty around interest rates, policy shifts. How does that impact deploying capital in the United States these days?
Well, certainly interest rates are a big part of the real estate industry, and the uncertainty of whether they're going up or whether they're coming down puts people on a pause. Now that rates got a little bit more stable, people start to get a little bit more comfortable with the market environment. Costs have come down a little bit. Labor is a little bit more available. Some markets have continued to strengthen, some have weakened, some have bottomed out. And so it is market by market, but certainly interest rates have a big play. Historically, I think interest rates are still at an okay level. I think that cap rates have adjusted quite well to those interest rates. It's been a bit painful for the last 2 to 3 years for some people that were really active 7 years ago that bought properties, that are having loans that are coming to maturity, that bought properties at really low cap rates based on much lower interest rate theories, right? They may have bought something at a 4 or 5 cap based on interest rates being at 2, 3, or 4%. Well, now you're at cap rates that are 6, 7, 8%, but you're borrowing at 5, 6, 7%. So depends, where you play, but it's sort of getting to a place now where I think we'll start to see more transactions. I think people still believe in growth within certain markets. In the United States, there's certain places where you have a lot of migration, a lot of immigration that's going on. You have a lot of trends that are occurring within specific pockets of the industry of real estate, right? You have data centers which are continuously grow that a lot of people are talking about, and a lot of activity. You have the industrial market, small bay, large bay, that is continuously growing within distribution markets. You have grocery anchored retail, which is performing exceptionally well. Today you put a property in the market, you're getting 10, 20 bidders. A couple of years ago, you probably had a couple, 2 or 3. And so now there's a lot more activity and good opportunities, I think, for buyers and also I think to lend as well.
I think what's really interesting about the United States when you compare it to Canada. So recently I was at a capital markets event that one of the banks hosted where they had a number of REITs from both sides of the border. And when you look at the Canadian public REITs, there's like 4 or 5, maybe 6 major players. You go down to the United States and it's not the Wild West, but there's a lot more opportunity for families, for individual investors to get involved in that market. How does that impact how we do business?
Well, certainly the markets there have more liquidity. There's more up and downs, right? There's more quicker trends. And so, returns in Canada historically have been a little bit lower than United States, but they're more stable. The United States is more of a transactional market in certain places. You have to pick the trends a little bit more carefully there. Things move a lot quicker. Real estate, you can be on one side of the street and it could be a AAA location. You can be on the other side of the street and it could be a terrible location. So location is really important. And there's a lot of markets. You have a lot of markets to be active in. You have a lot of choice. Canada, you don't have as much choice. There's not as many markets to invest in. So the US has many markets within the markets to invest. Yeah.
That's interesting. Thank you, Harley. We're going to move on to a new segment that we've recently introduced into the show, Market Minutes. This is called Market Minute. I'm going to ask you some rapid fire questions. The goal is to do as many as we can in 60 seconds. Best book that shaped how you lead?
Atlas Shrugged.
Interest rates in 12 months, higher or lower?
Higher.
One trend everyone should be paying attention to.
AI.
Best leadership advice you've ever received.
That's best leadership. Treat other people as you want to be treated.
Biggest difference between Canadian and US lending markets.
Volatility more in the US.
One habit that makes you a great leader.
Spending time with people.
One app on your phone you use every day.
LinkedIn.
Most important quality in a partner? Business partner, sorry.
Honesty.
What is one thing investors may be misunderstanding about the market right now?
Dynamics of it and location.
If you were not in real estate, what would you be doing? Appreciate you sharing your perspective today. Thank you again for being here.
Okay, thank you.